The jobs report almost gets lost in a week like this, but it came out this morning back to its normal, regularly scheduled programming, and we found out we added fewer than expected jobs in December, ending a year marked by a slowing labor market as firms seemingly have gotten a lot more cautious on hiring. The market is pricing for rates to stay the same in January, but should they be lowered sooner? Joining us now is KPMG's chief economist, Diane Swonk, and Wells Fargo Wealth and Investment Management CIO, Daryl Cronk. So is it seriously Swonk and Cronk? Oh, guys, this is too good. Welcome to both of you.
We've done this before, actually.
Have you? Okay.
Gotta laugh at something.
Okay. Diane, first to you. And I guess the obvious statement, and you and I have talked about the risk that the Fed doesn't finish the job and rates go higher, but do we think now perhaps enough soft labor market reports, productivity data seems strong, it's time to lower the rate?
Actually, productivity growth being strong is an argument for higher rates, and growth is still extremely robust. And that's something that gets lost in translation. If the underlying weakness in the labor market is more structural rather than cyclical, related to things like curbs and immigration, along with the uncertainty, we had sort of a perfect storm of events causing the hesitation and really virtual stalling out since the April tariff tantrum. In April, since May on, we've seen no job gains. It's really something pretty stunning. 84% of all job gains for the whole year were in the first 4 months of the year. This is a really hard situation. And if these are structural rather than cyclical weakness, cuts in rates alone cannot cure that problem. And that's what's really the challenge for the Fed. And it's why the Federal Reserve has said, they're going to step back and pause. They're looking to get beyond some of the noise of the government shutdown and the loss of economic data due to that and see better where the economy is. But we think the first rate cut is now in June.
In June. It's so crazy, Diane, that you have a situation, and I've seen the charts, and I agree with you. I mean, Occam's law, right? What happened in April? Tariff announcement. What happened in employment since? It's kind of flatlined. But at the same time, third quarter GDP was, 4 and something? And do you see Atlanta Fed's fourth quarter tracker is now over 5%? What's going on?
Yep. Well, we've got consumer spending is still extremely robust, that's something we actually count fairly well. There's other things in GDP we don't count as well, but that's 2/3 of GDP is consumer spending, and it's being carried by the top 20% of households. Some work that the Dallas Fed did, sort of dovetailing off of Moody's Analytics, suggests that 57% of that spending is now done by the top 20% of households, a record high. That is, not helping the bottom 80% who are struggling to make ends meet and not able to spend much more than the pace of inflation. I know that Mark Zandi is going to be updating his own analysis of the distribution of spending in the next day or so. But these are really important because they're against those things are giving us a jobless boom. We've had jobless recoveries. We've never had a jobless boom. This is something quite striking. And we don't know that the productivity gains, they're not due to AI yet. They're due to a lot of factors, overstaffing in the wake of the pandemic and getting staffs back to right level sizes by hiring freezes and trying to ride attrition, although quit rates have plummeted with the exception of leisure and hospitality where they soared in the month of November. But I think these are very important things to understand because that slowdown in the pace of hiring that we've seen, much of it is structural. And if it's structural, the Fed can't cure what ails us with rate cuts, and they could risk stoking a more persistent bout of inflation. We know that inflation will be lower just because of the zeroing out that happened on many of the cells for the month of October due to the loss in the October data. But we are worried about sort of a lingering inflation a bit in early part of next year.